This is lecture for chapter 11. This chapter is a continuation of chapter 10, and now we're going to focus on employers portion of payroll. So it's called payroll, taxes, deposits, and reports. And again, in chapter 10, we did the employee, EE, we abbreviated portion of payroll. In this chapter, we're going to focus on the employers, ER, we abbreviate, portion of payroll. Let me go directly to this slide, which I just copied from chapter 10. So we're focusing on this folder. We're focusing on the employers folder. What we're going to talk about in this chapter, we're going to talk about the portion of taxes paid by the employer. And these include, I'm reminding you, the employer matches Social Security and Medicare, which just match the same amount that employees paid, that we withheld from employees in Chapter 10. We're not going to pay income tax for employees, but we will have to deposit this portion, this federal income tax. We will have to send a check or make an electronic transfer, rather, to the IRS. We will talk about FUTA and SUTA, federal unemployment and state unemployment. And we're not going to mention much, but there's also some voluntary payments here. So first of all, let's talk about how and when payroll taxes are paid to the government. So who deposits payroll taxes, right? We do it. Employers make tax deposits for pretty much three taxes. We collect FEAT, federal income tax, from employees. We collect Social Security from employees and Medicare from employees. And then we match the same Social Security and Medicare. So this whole lump sum, which consists of these taxes, again, I want to say federal income tax, just the employee portion, Social Security and Medicare tax doubled because it's the employees and the employers' portions. And we make a deposit. And we have to remit payroll tax via so-called EFTPS, this electronic federal tax payment system. It's required in most instances, and how often the company makes a deposit depends on how much tax liability we have and how much taxes we actually paid in the previous year and a half. It's called the look-back period. So when I determine taxes for 2000, not the taxes, but the frequency of deposit, how often do I make a payment to the IRS for 2021, I will look for a so-called look-back period. How much payroll taxes did I owe from July 2019, July 1st, up until June 30th, 2020. That's a look-back period. If we owe less than $2,500, then we don't have to make a payment in taxes until we owe $2,500. So you don't need to really know the details, but in general, in the look-back period, if we owed in the past year and a half, if we owed less or equal to $50,000, then in the next year, we will have to make deposits every month. Once a month, we have to make deposits. We have to transfer electronically funds for federal income tax for employees, Social Security, and Medicare to the IRS. If we owed more than $50,000, then we have to make a deposit every 2 weeks, semi-weekly, every 2 weeks. For new employers that don't have a history, do not have a look-back period, if they owe $2,500 or more, they automatically become monthly depositor. And if the company has, at any day, they have $100,000 or more they owe in payroll taxes, then they have to make a deposit on the next banking day. Again, I don't necessarily think you need to know all these differences. Just know that who makes the deposit of taxes? The employer. Which taxes are deposited? We listed them. How often depends on how much taxes the employer owed in the look-back period. The more you owed, the more frequently you have to deposit. Okay, so employer Social Security and Medicare, you don't really have to calculate it, right? You just match it. So if employee if we withheld from employees $139.35 in Social Security taxes, we just match the amount. It's 6.2% on the cap on the earnings, and Medicare is 1.45%. So together right here, this is $343.88. So this is a journal entry, right? So the employer matches Social Security and Medicare. This is how we record it. We debit this new account. It's called payroll tax expense, and we credit two liabilities. Now, I want to remind you that these liabilities for employees' Social Security and Medicare we already recorded and took out of their full pay, of their gross pay, in Chapter 10. Right now, we're just recording the employer's portion. Again, debit payroll tax expense, credit Social Security tax payable, Medicare tax payable. Now, when we deposit double the amount of Social Security, right? When we make a payment, we deposit the double of Medicare tax payable. Okay, let's talk about deposit, right? So we make, at the end of January, these are our records. We have employees, Social Security, and employers, and the total is doubled, $1,114.80. And then Medicare, you can see the amount right here, $260.72. And the employee's portion of federal income tax, $620. So we have to make a monthly deposit. We have to make this, we have to pretty much make an electronic transfer of $1,995.52. So we're gonna debit these three amounts for liabilities. When we deposit, when we make a payment, our liabilities go down, minus, debit. So we will debit Social Security tax payable, Medicare tax payable, employee income tax payable. What do we credit? We credit cash. Here is the journal entry right here. Debit three liabilities. They all are decreased, paid out, credit cash. Record payroll tax deposit with the IRS. Now, you don't necessarily have to prepare this form, you just need to be aware of what this form includes. This is Form 941. It's prepared every quarter, 4 times a year. This form includes all previous taxes that I listed. It includes information on Social Security, Medicare, and federal income tax for employees. The form, like I said, is quarterly. The due date for this form is the last day of the month following the end of each calendar quarter. So if my first quarter is January, February, March, then I have until April 30th to submit this form. You can look at the form, look at how what the information it includes in your textbook. Again, I don't think you have to complete the form in your homework. You just need to know what this form 941 includes. I will talk briefly now about another form 940, which will be for FUTA, federal unemployment. So form 941 includes, and sometimes we call Social Security, Medicare, and federal income tax, we call them 941 taxes because they're all listed on form 941. Okay, W-2. You all should be familiar with W-2 if you ever worked. For W-2, you receive this form in the beginning of each year from every employer, and you use W-2 to prepare your taxes. So here's an example of W-2. So this is your compensation that is taxable for federal income tax. Compensation taxable for Social Security. Remember, there is a limit to Social Security, right? So if you made more than $122,700, then on this form, only on W-2, let me go back there, only $122,700 would be taxable for Social Security. For Medicare, everything. If you made $200,000, you would have $200,000. But for Social Security, it cannot be above the cap. What about income tax? You know, if you, for example, have 401k, 401k is tax exempt, but it's only tax exempt for income tax. So if you have 401k, you would have a note here, and that amount would be excluded from box number 1. So boxes 1, 3, 5 are taxable amounts, your earnings. Boxes 2, 4, 6 are actual federal payroll taxes. And then you have state information right here. You've got state tax, taxable amount. I don't know, they should have some amount right here in box 17 would be the amount of state tax. So if you look at your W-2 form, you will find it there. And guys, W-3 is the form we don't see. It's the form we submit to the IRS. So all W-2s together, if I have 100 employees, if I add it together, I have a summary for all employees on form W-3. So the amounts on form W-3 must equal the sums of the amounts on the attached forms W-2. So this is for the entire company, for all employees. Okay, FUTA and SUTA, right? FUTA is a federal unemployment tax. It's usually very small. These amounts, these monies are not used to pay out the actual unemployment benefits. It's used for administrative purposes. You know, if you have a state unemployment office, you know, the rent for the office, the salaries of the employees of the office, this is what FUTA pays for. SUTA is usually a higher percentage, and it changes from company to company, from a business to business. You know, right now with high unemployment due to the pandemic, I will expect that SUTA will increase significantly the percentage. And that's the actual amounts of money. It's a piggy bank. Everybody pays in this bank. All businesses pay in this bank. And this state unemployment tax is used to pay the actual unemployment benefits. So FUTA rate, I am simplifying always, is 0.6%. So I'll go right here. FUTA is always only 0.6%, very small. And the cap is only 7,000. So if the employee makes more than 7,000, we do not pay taxes for FUTA. As soon as she made $7,000 for the rest of the year, we're not paying any FUTA. Starting January 1st, we start paying FUTA. So the maximum actually we're going to pay into FUTA, if you take $7,000 and multiply it by 0.6%, it would be only $42 per employee. SUTA depends. So I want to talk about SUTA a little bit more. You will be always given the percentage. The rate will vary. The cap, we will also assume to be $7,000, even though it depends on the state. In California, it's $7,000. In many other states, it's much higher than $7,000. But your textbook assumes the cap for SUTA is $7,000. So this is how SUTA rates work in general. In California, if you're a new employer, you have to pay, I might be mistaken a little bit, but I think you have to pay 3.4% for the first 3 years. 3.4% in SUTA. In these 3 years, you deposit money with the state, with EDD, for SUTA, for state unemployment. And the state is keeping track if you laid off any people. If you did not lay off any people, this piggy bank, the amount of money you put in 3 years grows high. And so after 3 years, your rate will go down. It could go down quite low. But if, however, in these 3 years you've been laying off employees, and these employees have been claiming unemployment benefits, the state is keeping track how much you paid in and how much has been withdrawn by your former employees. So if your balance is pretty much negative, you calculate the ratio, the state calculates the ratio, then your SUTA rate will go higher. It will go higher. That's why sometimes companies are forcing employees to actually quit, so that, you know, the employees, the former employees, are then not eligible for unemployment, and the company's unemployment rate will not go up. But in your textbook, you will always be given SUTA rate. So here's an example. So taxable wages, $2,247.50, 0.006. This is unemployment for federal unemployment purposes. 0.6% or 0.006. Don't make a mistake here. If you do 0.06, that's 6%. Our rate is only 0.6%. So $13.49. State unemployment, they will always tell you what it is. In this example, it's 4%. So together, these unemployment taxes. How do you journalize it? Again, you use your account payroll tax expense. These are payroll taxes that are paid by the company. Employees do not pay these taxes. So we debit this payroll tax expense, it's an expense account, and we credit two liabilities, FUTA payable and SUTA payable. Okay, you will send checks separately to deposit SUTA and FUTA. SUTA goes into the state, of course, the check or the electronic transfer. So when you make a payment of the state unemployment tax, you decrease debit the liability. You send money, you credit cash. Same with FUTA. Let me skip this slide for a second. For FUTA, I just made up this amount. You make electronic payment, you pay it to the federal government. FUTA payable goes down, debit, cash goes down, credit. I do want to go to the previous slide. So, as I said, earnings over 7,000 are not subject to SUTA or FUTA. This is so-called unemployment cap. So if I have an employee and he makes $22.40 per month, I have to keep track of his cumulative earnings, right? By the end of January, everything is taxable for unemployment because he's below 7K. February, he makes another $22.40, so his cumulative is now $4,480. The entire amount of his gross pay is taxable. $2,240 is taxable. March, weeks 1 through 4, he makes another $22.40. We get to $67.20. Everything is taxable. But then in the week 5 of March, he makes additional $560. That puts him above cap, right? So even though he made $560, I need to figure out how much of this $560 puts him at $7,000. So he was at $67.20, so he was $280 short of the cap. So out of $560, only $280. So if this was his paycheck, only $280 would be taxable because this $280 would put him at $7,000. An additional $280 above the cap, and the company does not pay FUTA or SUTA. And from that moment on, April, May, June, July, we do not pay any SUTA or FUTA until the beginning of the next year for that particular employee. Okay, and then guys, as I promised, there is Form 940. So 941 was a quarterly form for Social Security, Medicare, and federal income tax. Form 940 is an annual form, and it's a form annual just for FUTA. It's only for FUTA. So again, you don't necessarily have to prepare the form, but you can look at it in your book on this slide. 940 is once a year for FUTA. The last objective here is workers' compensation insurance premium. So companies must provide workers' compensation if an employee hurts herself on the job. They must pay medical benefits. Sometimes they have to pay for retraining. And to ensure that the company has the money to pay for injuries, all of the states in different variations require companies to actually buy insurance. Just like we have auto insurance, companies must purchase so-called workers' compensation insurance. And employer pays this insurance premium based on the type of employees they have, what type of jobs they do. It depends on the risk involved with the work performed. So if you have office employees, your premiums for office employees will be much lower if you have factory employees or if you have warehouse employees. Chances of being hurt at a factory or at a warehouse are much higher. This is actually one of the reasons why we're losing manufacturing jobs overseas, because there is no workers' compensation if you ship the manufacturing jobs to other countries. But if you keep them in the United States, you have to pay high premiums. So there are two ways to handle workers' compensation insurance. You can pay an estimated premium in advance. It's usually based on your payroll from last year. So you pay in advance, and then at the end of the year or a period, you look at your actual salaries and you adjust. Sometimes you get a refund, sometimes you have to pay an additional amount. Another way is to pay a deposit in the beginning and make monthly payments. We will look at the first example. So we will pay an estimated annual premium in advance, and then we will have to make adjustments. So we have two groups of employees. By the way, this is why in chapter 10 we had to sometimes have two debits in our journal entry. We would have like office salaries expense and shipping wages expense. We have to separate them, and one of the main reasons is because the premium rates for compensation insurance would be different. So the rates are right here. So for office workers, it's 45 cents per $100 of labor cost. But for shipping workers, much higher, $1.25. Look at the difference, more than almost 3 times higher. So in the beginning of the year, we simply made an estimated premium payment of $1,000. It's based on employee earnings from the previous year. So January 15th, it went into prepaid workers' compensation insurance. So look at this. This is not insurance expense. It's a prepaid insurance account, right? And I sent a check, cash. So I thought I would owe $1,000. In reality, we look at the end of the period and we see that the payroll is actually right here. So office work, 24,960. So we have to pay 45 cents per $100. So I move my decimal 2 points. So I would take 249.6. So I divide it by 100, right? I pay per 100. So it would be 249.6. multiplied by 45 cents. I get $112.32. Same with shipping work. I would take 919.1. So I take the amount of payroll, divide by $100. I get 919.1 multiplied by $1.25. I get 11.48 and 88 cents. So I paid $1,000, but I actually have to pay $1,261.20. So I have to pay the difference, right? This difference, $261.20, I have to record. Your textbook says record it this way. You just record it on December 31st as the amount you owe. I would say if you send a check to your insurance company, you credit cash right here, right? Oops. Why did I do this? Sorry, guys. You debit the workers' compensation now. Insurance expense, it's already expense. It already accrued. I'm sorry, it already incurred. It happened. And you credit cash if you send a check. If you just owe the money, you credit the payable, the liability account. That concludes chapter 11. Thank you.